We invest across a spectrum of businesses, from venture capital on the left through to private equity, as I mentioned, and that tends to be an age, stage, size and risk point of view. But I think fundamentally there's a few themes that we play into. One is that of growth. That's growth. How can technology help deliver that growth? And how can actually business performance deliver great returns? We don't use a lot of leverage in our investments. It's all about investing in high quality businesses with strong growth prospects that we feel that we can add incrementally to their prospects as we get involved, as we invest and we help drive these businesses forward. I think the real discussion that should be had, and hopefully we can touch on in the panel discussion, is that alternatives, whichever way you cut it, alternatives are growing all around the world. It's happening in Australia, but at a much slower pace. So on the left, you can see the growth of alternatives relative to other asset classes. But on the right, by any measure, Australia is relatively underpenetrated. And so we're not kind of making this up. This is a real global trend. We see it in many different asset classes. Clearly, I'm here to talk about private equity. But it's really about how do we kind of improve our reach and touch a broader investor base more successfully than we currently already do.
And so when I think about our activities, the two things I'd like to leave you with today is to think about private debt as being an asset class that does truly deliver that stability of client capital, investor capital, but also delivers an attractive uncorrelated source of income. Now, why do I say that there's stability of capital that can be provided through the asset class? Well, it's important to not only think about where you sit in the capital structure. Obviously, equity is the first asset class that wears the risk of loss. So any deterioration in the financial performance of a borrower is borne by the volatility or the value of equity, shareholders' capital. You invest in debt to gain the protections through appropriate lending terms and conditions, imposing covenants, controls, taking security, monitoring and managing the risk associated with providing debt, but also to structure the long-term sustainable capital structure of a company that ensures that equity volatility does wear the risk of loss. So if you think about a company that might, say, trade on 10 times earnings, as a lender you'd be looking to, say, maybe provide debt of, say, 3 times. So effectively ensuring that there's a substantial amount of capital in the capital structure that can absorb that risk of loss. I think one of the things that's also often misunderstood in the Australian market is Australia has probably one of the most protective corporate insolvency legal frameworks globally. The interests of a secured creditor rank in priority to all other asset classes and creditors of a company. And so if you think about times where there's been volatility in the market, you think back to the GFC, or you think back to March, April of 2020, companies raised an awful lot of capital, destroyed shareholder value, did deeply dilutive equity raisings only to restore their balance sheet. The risks for an Australian company corporate director to trade whilst insolvent or to take any risk in terms of the performance of that company obviously exposes them to quite considerable personal risk. So again, I believe that when you think about the Australian market context, you think about it in the context of the lack of alternatives away from the banks. You think of also the protective nature of the Australian corporate insolvency legal framework and the low or more conservative bank dominated nature of transactions that are completed in our market compared to some of the excesses that we see in both the European and US market. I believe that Australian corporate credit, private debt in the Australian market, delivers a better risk-adjusted return than in other forms of private debt globally. And that's because of the unique nature of our market, and it's also a function of the fact that we do have an immature debt capital market that is dominated by the 4 domestic major banks. But the corporate insolvency and legal protections afforded to creditors is obviously paramount in also delivering that stability of capital and protection. It does deliver an income that is attractive. The majority of loans in the Australian market are priced off floating rates. They tend to be short-dated exposures. So certainly from our perspective, we would prefer to lend for shorter periods of time, generally between, say, 3 to 5 years. And the reason you do that is to lower investors' risk to credit risk. You're lowering investors' risk to changes in credit spreads. You're also increasing the level of liquidity across the portfolio of loan assets that you provide. But you also have the opportunity to recycle that capital whereby you charge fees that generates an income for investors. So the source of income to an investor in private debt in the Australian market, unlike the risks that investors have seen in traditional fixed income where duration has impacted adversely client portfolios, has delivered not only capital stability, but immediate participation in rising interest rates. And so the key skill set to be able to deliver this for investors is the capacity to originate transactions. Often we hear people talk about the illiquidity of the asset class delivering a premium. I don't believe in that in any way, shape or form. It's about the skill set of the lender to be able to build good long-term relationships with companies, to deliver a service and to differentiate their structure and the terms and conditions upon which they finance the company and differentiate it to other parts of the market that allow you the opportunity to lend. You're seeking to ensure that the provision of a loan is just not commoditised. It's a skill set to be able to deliver financing in an appropriate way on terms and conditions that will be acceptable to the borrower. That capacity to originate a transaction, negotiate the fees, negotiate the margins, to understand what are the risks that need to be mitigated in the financing structure are very important. And then in terms of documenting the transaction to protect investor interests. I believe also an appropriately skilled manager has to have good workout and credit reorganisation, restructuring skills to manage through periods when economic or business conditions become more challenging.
I think it's worthy to sort of think about just fundamental principles around what we're trying to do for clients. We're trying to plan for clients for a given outcome, and the more certainty we can have on that future outcome, investing in inherently uncertain asset classes, it makes the planning process more effective, right? So why are we adding to alternatives? We're trying to build a more resilient portfolio. We're trying to build something that will increase the certainty that we can deliver for those clients at that given outcome. And ultimately, that's what we're trying to do, right? So I think as, you know, and we've heard on numerous occasions, like the private and unlisted asset sector is growing, you know, so there's actually been a decline in the number of public listed companies, and there's been enormous growth in private markets. So this is increasingly becoming a larger part of our investable universe. And, you know, if you look at Katie's presentation and going forward, that condition of more volatile markets, more difficult markets is going to be absolutely, a lot more difficult for clients going forward to plan. We're going to have less certainty on outcomes, more risk and more drawdowns. And so it's really, and higher inflation also means the importance of delivering for clients is going to be important. So if we can access other asset classes, not traditionally tied to market betas in equities and bonds, and get more certainty around that return, that's why we're investing here, right? Or that's why we invest here.
Well, given that it's IMAP and managed accounts, I think the first thing I'd say is you can, and there's a way, and I'd say especially if you've got a bespoke SMA program, SMAs are perfectly suited to having illiquid alternatives in there. Because unlike a super fund, you've got no member equity issues because you've got different unit price for all the underlying assets. So if one does get locked up, because that's the risk, that's the sort of, you know, Kyle was saying, the corner you've got to think around, it doesn't affect the rest of the portfolio. So that's the sort of yay kind of part. The slightly more boring reality for SMAs that are widely available is that you've, well, in fact, all SMAs have to have a shadow portfolio. So if you're running a bespoke portfolio, you can, but you have to manage it very carefully. The cash flows, especially if you've got some big clients in there, because it can gung up the system a little bit. That's just the platform functionality. And if it's one that's more widely available, our own view is that it sits outside. It's something that you may well want to do, but it's a sleeve that sits outside, because not only you've got the shadow portfolio thing, which is a real constraint, but this is something that's built for many investors, and that kind of illiquidity might not be suitable for all investors. And also the reason why, one of the main reasons why SMAs are becoming so popular is reducing the admin constraints on advisors, and you don't have to write an ROA for that. So that all kind of works. And then I've got
That's correct. So there are a range of things that a lender does to protect and preserve capital, one of which is having exposure to floating rates, short-dated exposures, as I mentioned, but equally we have ratchets like what we call pricing grids. So if credit quality was to improve or deteriorate, the margin will ratchet based on the credit quality of the borrower. And of course, you know, the key to our asset class in terms of delivering returns is actually an investment in direct origination, the capacity to have those relationships that drive the ability to find good lending opportunities and then deploy capital in a sensible way. So, but you know, if you think about the experience that a lot of client portfolios have had of recent times, is, you know, obviously managers have got duration wrong, and now investors have lost capital, and those that are now stuck in those investments are generating a very poor yield. And so I think one of the things that's quite attractive in our market is the fact that you're providing funding where capital is scarce. You're taking advantage of market inefficiencies. And so right at the moment, for instance, the banks have had a clear position over probably the best part of the last 5 to 7 years where they've really withdrawn from financing commercial real estate related activities as they've deployed their capital more onto the consumer home loan side. And as a result of that, access to capital is restricted, and the returns that are able to be delivered for investors through directly lending for those activities has been quite attractive. I think in our own funds we're now yielding close on 9%. For first registered mortgage, short-dated, secured property loans, which I think on a risk-adjusted basis is a very attractive position.
Look, I think our job is not to pick the highs or the lows. We've actually got to invest through the cycle. And therefore what you have to do is, you know, keep up a consistent pace, but then adjust your approach depending on how you're feeling or how you're seeing things. And so it's not kind of like the same approach in all kind of market conditions. And therefore, at the moment, you know, we think a lot about kind of, you know, wage inflation within companies, portfolio companies, both existing, but some of the investments we're going to make, you know, kind of what's their ability to, you know, to push prices through to offset, you know, what's their reason for being, what's the competitive advantage, can you sell value, not cost? There's a number of different things that you factor in going forward. So we do look at it, I think, you know, if we look backwards at our existing portfolio, we don't use a lot of debt, so we don't have those stresses in place. We do use modest leverage. We do use matrix. They're an excellent partner. But we, and so I think it was some of those decisions around business quality rather than financial structures driving outcomes, that standing us in good stead as the kind of cycle's changing. Going forward, I think the attractive thing is that the kind of marginal dollars left the system. And that basically means that capital's become more scarce, and therefore, if you're staying the course and you've got capital available, then there should be opportunities, and we certainly feel that that's the case. But we're certainly not smart enough to pick our timing. You know, kind of like you get in when things are, you know, at a low and out when things are high. You've got to be quite consistent. But you know, the chart that I put up in the slide presentation is that through cycles, private equity outperforms. It's not just kind of, you know, in one environment. It really is in all environments. But, you know, the kind of the circumstances and assumptions can change, and you've got to adapt to that.